Somewhere in Europe, a Volkswagen showroom glows quietly at night. Rows of Golfs and Tiguans wait under soft light. To most drivers, this looks like an ordinary car lot. But behind the glass, a completely different business is running. Volkswagen is not just a car brand anymore. It is one of the most tightly engineered profit systems in Europe. Millions of people trust the brand for reliability and value. Few ever ask how the dealership itself survived. Even fewer understand how the money actually moves. This is the hidden economy behind every Volkswagen showroom, and it is far more complicated than simply selling a car for profit. Every year, hundreds of entrepreneurs dream of owning a Volkswagen franchise. The brand feels safe, established, and almost recession-proof. Volkswagen sells more cars in Europe than almost any other brand. That volume creates a powerful illusion of guaranteed income. Owning a VW dealership feels like owning a piece of a giant machine. There is prestige in the badge on the building. Banks trust Volkswagen dealers more easily than smaller, unknown brands. Family businesses pass VW dealerships down for generations. Some dealer groups operate more than a dozen VW locations at once. Volkswagen's badge is recognized in almost every country on Earth. That kind of universal recognition removes a huge marketing burden. New owners assume brand recognition alone will drive constant traffic. That assumption is only partly true. On paper, this looks like one of the safest bets in retail. The reality is far more layered than that first impression. Getting approved as a Volkswagen dealer is not simple. Volkswagen does not sell franchises to just anyone. Applicants need serious capital before they even apply. A single showroom built to VW standards can cost millions of euros. Land alone in a good location can cost hundreds of thousands. Then comes construction, following VW's strict corporate identity design rules. The glass facade, lighting, signage, and layout all follow a manual. Nothing about the look is left to personal choice. In Germany, a full-service VW dealership can require an 8-figure investment. In smaller Eastern markets, entry cost can fall closer to 1 or 2 million euros. On top of construction, dealers need floor plan financing for inventory. Floor plan financing means borrowing money to stock unsold cars. A mid-sized dealership might carry 2 to 5 million euros in inventory. That inventory sits on a loan, not owned outright. Every day those cars sit unsold, interest quietly accumulates. Volkswagen also expects proof of sufficient working capital reserves. Without that reserve, approval is unlikely regardless of location. Add staff hearing, tools, diagnostic equipment, and technician training. Total entry cost can easily climb past 3 to 8 million euros. Exact numbers shift by country, city, and dealership size. Some Eastern European markets cost less to enter. Western European capitals cost dramatically more. This is not a business you start with savings alone. Applicants typically submit detailed business plans and financial statements. Volkswagen reviews an applicant's track record in the automotive industry. Experience running a dealership for another brand can help the application. First-time entrepreneurs face a steeper uphill climb. Volkswagen also protects its territories carefully. A new dealer cannot simply open next to an existing one. Regional exclusivity is negotiated, not guaranteed forever. Manufacturer approval depends on financial strength and business history. Volkswagen wants dealers who can survive slow years. It also demands long-term commitment to brand standards. This barrier keeps casual investors away from the business. It favors experienced operators with deep pockets. Once approved, the real question becomes, how does the money actually flow? New car sales look like the obvious profit source. In reality, new car margins are thin. Volkswagen is a mass-market brand built on volume, not luxury pricing. Typical gross margin on a new Volkswagen sale sits around 5 to 8%. After discounts and incentives, that margin often shrinks further. Online price comparison tools have made buyers more aggressive negotiators. Customers now walk in already knowing the lowest quoted price nearby. This transparency has quietly crushed old-school negotiation profit. So dealers rely on other income streams to survive. Trade-in vehicles create a second profit layer. A well-priced trade-in can be resold with healthier used car margins. Used Volkswagens carry noticeably higher margins than new ones. A used car's price is less transparent than a brand new sticker price. That pricing flexibility lets dealers protect their profit more easily. Certified pre-owned programs add another premium layer to used car sale. Financing arrangements add another income stream. When a customer finances through Volkswagen Financial Services, the dealer earns a commission. Insurance and extended warranty add-ons generate extra profit per deal. This bundle is often called the finance and insurance department. Some dealerships earn more profit from financing than from the car itself. F&I departments often operate on commission-based incentive structures. A skilled finance manager can meaningfully boost a dealership's monthly profit. Warranty products can carry profit margins above 50%. This is why finance offices are treated as a specialized profit center. Then there is the department almost nobody talks about, the service and parts department. This is where Volkswagen dealerships truly make their money. Every Volkswagen sold today becomes a future service customer. Oil changes, brake pads, and diagnostics generate steady recurring income. Labor charged per hour in the service bay carries high margin. Genuine parts are marked up significantly above wholesale costs. Gross margins in service and parts often exceed 40 to 60%. Compare that to the 5 to 8% margin on a new car. This is why veteran dealers call service the quiet cash engine. A busy service bay can cover almost all fixed costs alone. Regular customers create predictable, recurring service appointments. Loyalty programs and service reminders keep that appointment book full. A well-run service department can operate almost independently of new car sale. Some dealer groups even build standalone service centers away from showroom. This concept even has a name inside the industry. It's called the absorption rate. When service and parts profit covers total overhead, the dealership becomes resilient. New car sales then become almost a bonus on top. Behind the scenes, manufacturer money games shape everything. Volkswagen pays dealers something called a holdback. Holdback is a small percentage of each car's price paid back later. It is designed to smooth out cash flow and reward loyalty. Dealers also receive periodic sales incentives for hitting volume targets. These incentives can be the difference between a profitable month and a loss. Miss the target, and that extra margin simply disappears. Manufacturer incentive structures shift frequently based on market conditions. Dealers must constantly track changing incentive programs to protect margin. Missing a filing deadline can mean losing thousands in rebates. This turns basic paperwork into a genuine profit or loss decision. Floor plan financing adds constant background pressure. Every unsold car generates daily interest expense. The longer a car sits on the lot, the more it costs to own. This turns inventory into a ticking financial clock. Cars that don't sell within weeks slowly eat into profit. Running a Volkswagen dealership is expensive beyond the showroom itself. Sales staff, service technicians, and administrative teams all need salaries. Employee turnover in sales departments tends to run high industry-wide. Constant hearing and retraining adds a quiet, recurring cost. Certified EV technicians require specialized high-voltage safety training. That training is not optional. It's mandated by Volkswagen. Technician wages have risen sharply as EV skills become scarce. Attracting qualified EV technicians now requires competitive salary packages. Facility upkeep must match Volkswagen's corporate identity standards constantly. Periodically, Volkswagen updates its global showroom design language. When that happens, dealers are expected to renovate. These renovations can cost hundreds of thousands of euros per site. There's no real opt-out clause without risking the franchise. Marketing co-op contributions are another ongoing expense. Dealers often must match manufacturer marketing spend locally. Insurance for inventory, liability, and property adds further costs. Utility bills rise as EV charging infrastructure expands on-site. None of these costs disappear during a slow sales month. Some costs only appear after years of ownership. Diesel-related trust issues still echo through resale values in some markets. 2015 emissions scandal permanently changed public perception of clean diesel. Even years later, some buyers remain cautious about older diesel models. That caution can quietly affect trade-in and resale pricing. Software and connectivity systems now require constant technical updates. Dealers must invest in diagnostic tools built for connected, software-based cars. Falling behind on technology support risks customer complaints and warranty issues. Facility compliance audits from Volkswagen can trigger surprise upgrade costs. Currency and interest rate shifts can quietly alter floor plan costs. Sudden rate hike can turn a profitable quarter into a loss. Long unsold inventory sometimes forces panic discounting to clear space. That discounting directly erodes the thin margin dealers depend on. None of this shows up in a simple startup cost estimate. The biggest disruption right now isn't hidden at all. It's happening in plain sight across parts of Europe. Volkswagen has been shifting toward what's called an agency sales model. Under this model, the manufacturer sets the price, not the dealer. Dealers stop owning inventory outright in this new system. Instead, they act more like sales agents for a fixed commission. This removes some financial risk tied to unsold inventory, but it also removes the dealer's power to negotiate margin. Profit per car sale can shrink significantly under this model. Many dealers see this shift as a loss of independence. Some dealers have publicly pushed back against the agency model shift. Trade associations in several countries have raised legal and financial objections. Volkswagen argues the model creates pricing consistency for customers. Dealers argue it strips away their core independence and upside. It's a direct response to Volkswagen's push into electric vehicles. Electric vehicles complicate dealership economics in more than one way. EVs need far less mechanical servicing than combustion engine cars. No oil changes, fewer moving parts, less scheduled maintenance. That directly threatens the dealership's most profitable department. Remember, service and parts have always been the real cash engine. If EVs shrink service revenue, the whole business model shifts. Dealers must now find new profit sources to replace it. Software subscriptions, charging services, and battery diagnostics are emerging alternatives. But these new revenue streams are still far smaller than traditional service income. Charging infrastructure investment adds new capital pressure for dealers. Installing high-power chargers on site is not cheap or optional. Customer expectations increasingly assume that infrastructure already exists. Dealers who delay this investment risk losing EV-focused customers. Volkswagen also controls how many cars each dealer receives. Popular models can be allocated unevenly between regions. A dealer in high demand might still face limited stock. Meanwhile, competition from Chinese EV brands is intensifying across Europe. Newer, cheaper electric models are pulling attention away from traditional showroom. Younger buyers increasingly compare Volkswagen against fast-moving new entrants. This pressure adds long-term uncertainty to Volkswagen's own market share, and market share directly impacts every dealership's showroom traffic. Volkswagen's global scale still gives it major sourcing and pricing advantages. That scale helps offset some pressure from smaller rivals, but scale alone no longer guarantees dealership-level profitability. Local execution matters more today than it did a decade ago. Given all of this, why do so many Volkswagen dealers struggle? Thin new car margins leave little room for costly mistakes. Floor plan interest quietly drains cash during slow sales periods. Mandatory facility upgrades constrain smaller, independent dealers hardest. The agency model transition threatens long-standing profit structures overnight. EV transition risk threatens the most profitable department they own. Rising interest rates make holding unsold inventory even more expensive. Smaller dealers often lack capital reserves to absorb a bad year. Poor inventory management is a common reason smaller dealers fail. Ordering too many slow-selling trims ties up critical cash. Weak service department management leaves a dealership overly reliant on new sales. Without that cash engine, thin new car margins simply aren't enough. Many independent owners eventually sell to larger dealer groups. Consolidation is quietly reshaping the entire Volkswagen dealer network. Bigger groups can spread these risks across dozens of locations. Smaller, single-site owners often cannot absorb the same shocks. So is owning a Volkswagen dealership actually a good business? The honest answer is, it depends heavily on scale. A large, multi-location dealer group with a strong service department can thrive. Small, single-site dealership faces a much tougher path today. Volume alone no longer guarantees profit the way it once did. Margins on new cars remain thin and are getting thinner. Service and parts remain the true backbone of profitability. But even that backbone is under pressure from the EV shift. The agency model may permanently change how much dealers can earn. Investors considering this path should study local market saturation carefully. They should also study Volkswagen's regional EV rollout plans closely. A strong location in a growing urban area still matters enormously. How adjacent locations often see different traffic patterns than city center ones. Suburban dealerships benefit from steady, repeat local customers over time. Ownership today demands adaptability, not just brand loyalty. Volkswagen remains one of Europe's most trusted automotive names. But trusted does not automatically mean simple, effortless, or guaranteed. Behind every glowing showroom sits a business built on razor-thin margins. It survives on volume, service revenue, and constant financial discipline. For the right operator, it can still be a serious cash generator. For the wrong one, it can quietly drain capital for years. That is the real, hidden economics behind Europe's favorite cash cow.